Everyone. Hopefully you can hear me. Hopefully this mic is working. But hey, how's it going? Avin Savani here, with Savani Real Estate. Thanks for tuning in, on this episode, which is going to primarily revolve around asset management, in commercial real estate. But, yeah, it's kind of a touchback that I had. I made a video, I would say, late last year, end of 2022 on this topic. I kind of linked it with property management, but as I've kind of like grown and seen and met with more like investors and companies, I've definitely seen or kind of grown as far as knowledge goes. So I just wanted to share some insights that I came across, and also my opinion. Obviously, my past experience was in the asset management and financial analysis space. So I just wanted to kind of couple some of those experiences that I had within catering it more towards multifamily, which is like my main focus. But really, it's like overall commercial real estate. So yeah, I just wanted to kind of talk about this is going to be like a free flow conversation about it, how you can kind of optimize your property's performance, the necessary relationships that you need to keep, and overall how it fits within the team structure in like a well vertically integrated real estate firm. So yeah, as I'm kind of talking through this, I'll also have some background notes so that you guys can kind of follow along and kind of see my perspective on this. But some of these notes as well, it's going to be from outside sources, so I'll make sure to tell you like where I got it from, and also the other like underwriting resources that I use as well. So I'm just going to share my screen real quick so you guys can follow along with me. Okay. So awesome. So let me just like expand this screen. So we'll go through the notes section first, and then we'll go through other things. Okay. So as far as the notes go, I kind of use this um area to just expand on resources that I use. So the first resource obviously was IREM, so Institute of Real Estate Management. They had kind of like a PDF kind of report done on asset management within real estate, and I also just wanted to share the different approaches that people take to asset management. And on a side note as well, I also wanted to introduce some other sources that I've used in the past as well. So, for instance, Lone Star Capital, they're fantastic. They're in the DFW region, but they also have like free resources that you can utilize, underwriting models, and also just evaluating their deals that they have coming in their portfolio. And the owner and CEO of that company, Rob Beardsley, he's fantastic. He just provides just a complete, fresh and kind of like kind of higher level approach to private equity real estate, which is definitely on the come up. So definitely feel free to check them out. Also, just review their company structure and the types of deals that they've been operating. So yeah, and another source, James Eng. He's a commercial real estate, commercial mortgage broker in the DFW region as well. And so his company, Old Lending Capital, they're fantastic as well. So feel free to check them out. So he's got a YouTube channel, so he's got everything kind of as far as social media and everything. So he's fantastic resource that I've used. So yeah, he did a few episodes on asset management. He had kind of like a 101, 202, 303 series. So I kind of took different slides that he had from his presentation, and I also just wanted to share my input on that, with I guess a different perspective and other insights. So yeah, so the one thing that I would say to start out with when you're communicating with your property management team would just be this lacel structure. So Neil Bawa, he kind of talks about this. He's another investor, but basically leads, appointments, showings, applications, and leases. So how can we get down to leases at the end of the day, but also notifying these conversion ratios between these elements, so that we're pretty much maximizing our tenant leasing demand to our property, right? So with leads, obviously they can come from different sources. You have people driving by, you have referrals from families and friends, you have social media, you have your website, you have obviously the listing platforms, apartments.com, hotpads, Zumper, right? There's different ways to market, Zillow obviously too. There's different ways to market to your tenants and drive those leads to the door. But at the end of the day, you need to get those showings and actually establish that connection with them. That ultimately has a better impact as far as their decision on leasing, is ultimately getting to the showings and explaining things through and allowing them to envision themselves living in this unit for a sustainable period of time. So yeah, and then when you get down to applications, it's pretty straightforward process. Make sure that you have all the rules and regulations within your building disclosed at the bat, and also all the necessary reports that they need to get in to make sure that they're a qualified tenant to lease out your space. So this depends obviously across asset classes within multifamily. You have affordable housing, which could go through project-based Section 8 vouchers. You have HAP programs. You have different ways that tenants can stay in a facility to kind of help them transition in their life as far as like what financial position they're in to stay in a facility. But and then the other side of it, you have like student housing leases. You have students pretty much and parents as well co-signing on leases to ensure that they're able to pay the full term of the lease. And also you have master leases in place with other universities. So there's different ways to go about that. And then with the conventional route, it's really just dealing with individuals who have their own privately owned businesses and doctors, engineers, and a whole kind of like spiel of like other professionals that have the capability to support those rents and the other fees that are involved. So different mixed income tenant bases, and within an asset, you can also just have like a bunch of mixed income bases. So for instance, like your affordable housing program, it could be like 80% affordable, right? And then the other 20% is probably for conventional market rate units, right? Or it's like 50% affordable and the other 50 is like maybe for student housing or senior living or conventional rate, right? So there's different mixes within a property and the different types of people that you can attract to your facility. But that just depends on how you structure all your contracts with all the outside agencies and the legwork that you have to go with structuring those leases. So yeah, and the basic for applications and the necessary reports. So I kind of have like a 3 to 4 kind of step system. So you have your credit check, background and criminal check. You have your rent to income or income verification. If it's a well-established tenant, obviously, past 2 years of W-2s, so that they're in a nice stable position to afford the long-term rents, right? And yeah, and then ultimately when you get down to the leases, depending on like the utility reimbursement program, you want to make sure you verify that off the bat, and making sure that you have a RUBS program in place to bill back all the energy usage that they're going to utilize throughout the like the term of the lease. And other fees involved, obviously you have application and lease fees, you have pet fees, you have parking and garage fees, you have spa and gym fees for like a membership if there is like a gym involved in the facility, or other ways that you can like maximize the amenities that you offer and providing that to tenants at some type of cost. So yeah, and so that would be like the first layer of system that you want to verify with your property management team and the plan that you want to incorporate. But yeah, and then as far as other things within asset management, you have tracking your actuals versus your budgeted items. So basically, you want to make sure that the underwriting, you're challenging the acquisitions team as far as their underwriting and making sure that their assumptions, like as far as like rent growth, occupancy, vacancy levels, operating expense growth, property tax, and capex reserves, making sure that all the assumptions that are in the underwriting are justified. So, and ultimately the actual expenses, you make sure you want to track that on a month to date and year to date basis so that you can compare how your property is kind of stacking up against other competitive properties. So at the end of the year, you want to make sure that your operating expense ratio is in line with other competing assets in that market. So just to make sure that you're well kind of prepared for like the exit assumptions on your deal and that you're meeting that criteria as your kind of like actual performance progresses in line with your underwriting. So yeah, and then obviously return structure. So it's also wise to track the returns on your property. So within your waterfall structure, you're seeing how like the actual T12 and rent rolls, when you kind of plug it into that particular year, you're seeing how the returns are progressing and growing over time to satisfy your investors. So yeah, and obviously within commercial, you have the three main types that limited partners are going to be attracted to. So you have the LP net IRR, which excludes all your fees and everything. You have your cash on cash, and you have your equity multiple. So those three of I think I made like some LinkedIn posts on that, but cash on cash is essentially cash flow after debt service divided by total equity invested, and then equity multiple is total positive cash flows divided by total negative cash flows. So all the invested cash flows that you put into the deal, essentially. So yeah, so that's that, and then IRR, obviously it's a present value calculation, net present value calculation. So you're seeing what your return is when you equal net present value to zero over a period of time, and factoring all the kind of uneven cash flows throughout the years, and kind of like smoothing that out into your IRR. Other areas you have like average annualized return, which kind of divides the total return by the year and seeing how much you're getting like per year. And there's other ways to kind of go about return calculations, but those are things that I keep in mind. And obviously from a developer's perspective, you're also just realizing your yield on cost. So NOI divided by total project costs, comparing that to the cap rate and seeing if there is a sizable spread there to take on an investment. But that's kind of getting more into the acquisition space. So let me stay on topic here within asset management. So the other aspect is the PM software that you use. So obviously there's fantastic resources out there. You have Appfolio, you have RealPage and Buildium, you have Entrata, you have Rent Manager, Turbo Tenant, and Inago, which are some free ones. So it's a really matter of integrating all the different like legal docs and all the leases, and making sure that your property management team has the capability to managing that software on a day-to-day basis. Because that's kind of like the go-to, I would say, for all the data entry and pretty much like all the data that comes to the property on a day-to-day basis. So it's really important that they kind of stay up to date with everything, make sure that they're staying on top of like invoice entries, work order entries, all the new leads that are coming into the system. So it's an ongoing kind of process, but making sure that they're comfortable using that type of software, and it's like easy on the eyes. They can kind of go through it pretty seamlessly. I think that's a huge benefit to have. So it's a matter of just seeing like where which software is best suited for your on-site staff. And with RealPage, for instance, it's a company that I've tracked for a while. They have pretty much the full suite of everything. They have your CRM, your marketing, right? They have the vendor expense system, the procurement system. They have sustainability features within that, so you can integrate with other sustainability platforms. So it's really kind of an all-in-one kind of platform, but it's a matter of just seeing like what is really like reasonable for your type of investment. So obviously with like a mid-size investor, it may not be like feasible to have like all of these different things, which may not pertain to the institution until you reach the institutional level. So it's a good idea to just kind of talk with your like sales rep for that software and just realize like the best type of plan for you, and also your on-site staff, which are pretty much going to be utilizing it. So yeah, and then obviously with affordable housing, it's a matter of being on top of the legislation within your market. So the qualified allocation plan, housing action plan, the different policies that are in place for the LIHTC program. You want to make sure that you're reviewing that so you can kind of adequately convey issues that may arise to all the different team members. So your portfolio management team, your acquisitions and development team. It's just one area that you need to just keep in the back of your mind so that you're well aware if like things arise. So for instance, like rent control in that area or eviction protection programs, other programs that affect landlord-tenant relationships can definitely have an impact. So yeah, and then KPIs are huge. So on a weekly basis, when you're communicating with your property management team, it's good to have like a dashboard of a bunch of KPIs so that you can address areas of improvement and basically see where you can maximize the performance on the property. So comparing like month-to-date income plus 0 to 30 days delinquent rents to the budget, that's a pretty unique KPI to look at. So basically it's tracking if there are 30 days or 0 to 30 days delinquent rents, are we over or under budget for that month? And if there is some like wiggle room there, or let's say we generated good collections and we generated like most of our like gross potential rents and there's minimal delinquency at the property, I think that's a better sign to look at. But basically it's just comparing like the collections that you have plus like or subtracting out the delinquency and seeing if you're over or under your GPR for that month. So yeah, and then another thing would be actual OpEx versus budget. I already just went over this, but basically all the operating expenses at your property. So repairs and maintenance, service contracts, like landscape contracts, payroll, marketing expenses, general administrative, utilities, property taxes, insurance, as well as your management fee if you are outsourcing to third party. But it's a good idea to just track each and every one of these items and see where you can improve for that month and also overall during the year too. So for instance, for repairs and maintenance, you want to make sure that you're staying on top of your make ready costs and your turnover. So within one move out and a move in, you want to make sure that there is some standard operating procedures in place that your team can kind of go through and just realize all the necessary things you need to touch up and fix. So painting, flooring, or wall damage, or appliance like fixing up, or anything that just makes it look better for the next tenant. It's good idea to kind of review that. And then getting down to your service contracts, you have your landscaping, you have your pest control, You may also have like leasing commissions in here, depending on how often you utilize a broker. But um, yeah, and then so service contracts are huge because sometimes you might be locked into kind of like a yearly plan, and it's hard to get out of that. So it's a wise idea to just make sure that you have a proper budget for that. Um, yeah, and then as we work down the list, so marketing expenses and general administrative. So as far as marketing, the amount of marketing that you're using, social media, other listing platforms, website development, other areas where you're kind of attracting the most leasing demand to your property. Make sure that you have a nice system in place so that you're spending the right amount of money, but also realizing like performance and results from that. So there's no reason in putting all this money into marketing if it's not really yielding any results. So it's a good idea to just audit that and make sure that things are kind of working as planned. And then with general administrative, these are all the necessary expenses that you have on site. So supplies, TVs, security systems, uh, laptops, notepads, or sticky notes, or whatever you need to operate on a yearly basis. That's really what you need. Other things could be like professional and legal fees. You could have other types of fees involved from outside contractors and vendors for general administrative. But yeah. And then now working down to our utilities, which is huge operating expense. So with sustainable design, I think it's a benefit to have sustainable design practices in your plan, but it's also wise to see the actual payback period of those sustainable practices. So low flow like faucets, toilets, shower heads, Energy Star rating, electricity systems, or water and sewer systems, and HVAC systems, right? So it's a good idea to make sure that the type of investment that you're putting in, that you're actually reducing your energy bill for the long term by like 20-30%. So that's a good goal to keep in mind for utilities. And obviously, since you're billing back your utilities, obviously depending on the type of tenant base that you have, but if you're billing back your utilities and you're getting back that big portion of other income, that's a big benefit and savings over the long term. So yeah, those are all your controllable expenses. Now let's get down to your non-controllables. So with property taxes and insurance. So why don't we start out with insurance? I think it's a huge benefit to just realize what coverage that you have potential for bundle ups. So for instance, you have commercial property damage, general liability insurance, you have business income and loss insurance due to fires, natural disasters, or pretty much like vacancy loss that could result from some type of disaster at your property. You have flood insurance, you have other types of insurance at your property. So it might be wise to just consult with your insurance broker, just talk through all these plans and all these companies that are offering what they are, and just realizing the best coverage for your property, and a reasonable premium plan, and a reasonable amount of deductibles as well. So yeah, and overall, the last thing would be property taxes and your management fee. But for property taxes, it's a matter of how often your county reassesses your taxes, the growth rate between those years, and the types of taxes that they charge. Because sometimes many markets can get excessive with property taxes, as you're well aware. So you have your general real estate property taxes, you have your school taxes, district taxes, yeah, I just said school taxes, but you also have like franchise taxes. So there's really a matter of just understanding how much your tax liability for that year is going to be. And I like to keep kind of like a buffer of like 10 to 15% at the max of your property taxes kind of getting into the total operating expenses, I would say. But 10% and 15% is pretty high. But you want to make sure that you're if it is pretty high, that you're exercising some tax appeals, and you're going through the process with the township and saying, hey, we're providing like necessary housing for this community, and we're really getting hit with this tax burden, which is devaluing our property and not really helping keep the lights on. So that's one aspect to just discuss and see if it's reasonable to go through a tax appeal process with your county for. So yeah. And then lastly, management fees. So I made a video on this as far as like vetting a third party property management fee, the necessary questions that you need to ask, how to review their corporate structure, the markets and properties that they invest in. But yeah, so if you want to watch that, it's in like the video list. So just feel free to go through that. But yeah, so management fees, typically it's like anywhere from like 7 to 12% for, I would say, like full service management. But if it's like periodic management and not as much staff on board, it could be as low as like 3 to 4%. So it really just depends on how much staff that owner is going to have at the property, and if they are working like hand in hand with an outside property management company, that they're actually vetting them and making sure that they're staying true to their word as far as their performance. So yeah, that's like a kind of a quick kind of brief overview of operating expenses. But really it's a matter of your budget variance, making sure that your operating expense ratio is in line with your underwriting, and also just making sure that you're keeping or sustaining these vendor and outside contractor relations, because at the end of the day, they are providing value. It's just a matter of realizing value for both sides and strategizing for like a win-win long-term relationship. So yeah, and other KPIs, I think I was just looking at current occupancy versus projected occupancy. So it's a matter of just keeping in mind as far as like your notice to vacates and expiring leases that could impact your vacancy timeline. So when a tenant moves out or they're at the end of their lease period, it's always good to notify them and just make sure that there's a smooth move out process, and we're actively recruiting or generating leads for other tenants to fill that spot. So yeah, and then for pre-leases as well, this is obviously a benefit to your occupancy. So having pre-leases before like the lease up period, or having interest from tenants who do want to rent out a space, and they like the business plan, they like the operational plan that's in place. I think that's a huge benefit to have at your property. So pre-leases are great. Eviction proceedings, this is a tricky and I would say a bit of a sensitive topic to go through. But it's always a matter of just being transparent with your existing tenants. So within the period of an eviction, or like the steps that it takes to go through an eviction, I think it's really beneficial to inform your residents and make sure that they're well aware of what's happening. So basically, you want to make sure that once they are like a week or two late, that you're giving them constant reminders of making their rent payment on time. You may also like knock on doors and just have there's just like a casual conversation with them, and just seeing like, hey, are you able to make your payment, or how can we help throughout this process, so that you want to stay here for a longer period of time, right? But it's always a tricky situation to kind of go about. It's really a matter of engaging your interpersonal skills and just relating to them as much as possible and what they're going through. But as they get like 30 days delinquent, it's also beneficial to educate them about emergency rental plans. So obviously ERAP is a big program. You have emergency housing vouchers. You have free legal services if they are planning to just if the property management team is planning to go through an eviction. Educating them about also like HUD's online tools, so that they're well aware about like how they, if they aren't able to make their payment, how they can at least like stay within the facility for as much as possible, right? So yeah, and yeah, it's definitely a tough topic to have with your property management team, but it's always good to just keep track of from 0 to 90 plus days delinquent, where are our tenants at that are struggling the most. So yeah, and then as far as the last thing, so centralizing and specializations. So nowadays with property management teams, getting really technically advanced and implementing technology into the day-to-day practices. So you have AI bots and virtual assistants that are helping the on-site property management team with follow-up applications, report checks, background checks, like all that stuff. They're also assisting with like lease renewals, invoice entry, work order entry, and overall just like process compliance, and just like offloading a lot of duties that are really like time consuming, whereas they can really focus on the actual service that they provide to their tenants and other day-to-day activities that can maximize like the brand image and overall feel of the property. So I think that's one area that definitely I also need to kind of look into, such as like implementing like AI into like even just like the call menu option. Like when you call a property management team, you go through all the menu options, but you have like an AI system that's asking questions back to you, or just making this the or alleviating like actual human interaction, so that there isn't like repetitive processes on a day-to-day basis. So that's one area that definitely has evolved over the years, and it's one area that companies are using to evolve and stay ahead of the competitive landscape at their properties. So yeah, and as we go through this, so I pretty much touched on the major items within just like asset management with your property management, but I didn't really touch on actual higher level like strategic management. So within like a like institutional vertically integrated real estate investment firm, you're going to have everything pretty much in-house, right? So you have your property management in-house. You have your construction project management in-house. You may even have a good network of other developers or institutional partners that can come in and provide value, right? You obviously you have the portfolio management, which is kind of like the higher up to asset management. You also have like the fund accounting level for private equity real estate, or also affordable housing tax credit deals. So you have different layers and teams that you need to communicate with and keep relations with throughout the life cycle of the deal. But really, it's a matter of like kind of just bridging the gap between all these teams, right? And just being that like sole point of contact where if anyone has a question, just report it to the asset management team and we'll convey it to all the other teams, right? So it's really just a matter of also adjusting on the fly to whatever situation that you're put into, right? So you have a lot of like ad hoc programs or situations within asset management where you have some lender compliance or checklists that you need to go through with your lender to make sure that you qualify for a refinance. You have some tax credit equity investors that have questions on the deals and how it's being operated, or just some general questions, right? So throughout the day, you're going to get a lot of calls and other inquiries from a lot of people, but just making sure that you're like in a good state of mind, you're well aware of that property's like performance and like actual outlook, that just gives you the best leg up into explaining how it's actually what's actually going on, right? So you have the property level operations that you can convey. You have actually like the market insights and the data from like the secondary sources that you can convey to like acquisitions and underwriting team, like from your like your broker contacts and everything. And then you also have your tax credit compliance team, who's obviously well aware of the program and all the nuances within LIHTC deals, and other areas that they may have insights that maybe you didn't have the time to review the full QAP plan for the year, right? And there's a lot of like good knowledge in there that they may have that that you can just like kind of like sponge off of from them. So that's just one area where I think the most value in asset management is communicating with all these teams, getting insights from all these teams at the same time, and just being that kind of like heart in the system. I would say I think that's the best way to categorize it. It's like the heart in the system that just drives like all the different communications within the team. So yeah, and then other aspects. So these are slides from James Eng. He's he's a commercial mortgage broker in the DFW area, but he presented these slides, and I thought they were really great. And they just kind of like briefly just describe just like all the necessary things that you need within a solid asset management plan. So I thought it was great. But essentially, you have your revenue management system. So again, checking in on leasing and occupancy, reviewing the rent roll, the month to date financials and the T12 financials or the year to date financials, and also the occupancy like by floor plan. So you have like studios, 1 beds, 2 beds, so you can track the occupancy by each floor plan, which is great. So obviously with resident criteria as well, making sure that they're on pace to their background checks as far as like income verification, rent to income ratios, all of that, and other things like landlord tenant eviction records and laws and everything. Delinquencies, we address that. Expiring leases, we address that. We address like market. Oh, actually, we didn't do this. So market knowledge is a huge thing. So basically, it's called secret shopping or competitive shopping, I would say, within your market. So basically, it's good to stay on top of the competitive landscape. Maybe even just call in as like a tenant, even at like a neighboring like multifamily project that is like kind of comparable to your asset, and just talking with the property management team, gaining insights as far as the rents by like floor plan, and ultimately just seeing like what other amenities and other fees that they charge on top of that. So most of these things will be detailed out on the listing platform. So for instance, like apartments.com, they will list like out like all the fees and other amenities and services that are offered, and what like charge on top of that with your rents ultimately it comes out to be. But it's always good to just ask and also just get to know the property management team there, because they may also have maybe some data that you can also utilize. And also I know it's kind of a tricky situation to talk directly with a competitor, but it's cool to just like not like portray that, hey, we're literally a neighboring competing asset and we want to know all your data and make sure that we're on top of you. Not like that kind of situation, but just being very friendly, casual about it, and just gaining insights. I think that's the bottom line from that. Obviously you can do rent comps through like CoStar and Yardi and all that, but I think it's also a good strategy to just call in every now and then and see like what's going on, right? And then ultimately like monitoring and reviewing market trends. So this gets back to your broker or like real estate agent contacts, as well as your acquisitions support team. So with the acquisitions team, they're pretty much doing a bunch of this stuff that just pertains to the actual macroeconomic environment at your property. So obviously they're keeping track of population growth, positive migration, job growth, affordabilities, as far as like supply and demand characteristics, contractor developer activity. They're keeping track of all of this because it directly impacts if it's a wise market investment to begin with, right? So after it passes like the market test, I would say, then it just goes down to evaluating the property and seeing if it's actually within the business plan's criteria or investment criteria, right? So yeah, and then that's one area to keep track of because brokers can also help out with like leasing commissions and ultimately like having more insights as far as structuring residential leases. So it's always good to follow up with brokers on like a monthly basis. But yeah, and then expense controls. So as we get down to this, I kind of mentioned most of this, but yeah, you have your property or advertising marketing budget, you have payroll and staffing budget, you have your admin costs, utility programs, service contracts, tax appeals, insurance. So we already mentioned all that, but capital projects. So within CapEx projects, it's a challenge, I would say. But it's also cool to lay out like a 5-year or a 10-year CapEx plan to address like all the major items that need to get updated at your facility. So within like HVAC, roof, exterior parking lots, interior exteriors, right? You need to just put in a plan together that maximizes the quality and ultimately the results at your property and the satisfaction, tenant satisfaction ultimately at your property. So with CapEx projects, obviously it's going to have a direct impact on the rent bumps that you can get and how you can realize value from the actual money that you put into it. But it's a good idea. Also, good tip here is according to like a cost segregation study that you did at your property and realizing like the useful life of each and every item at your property, it's a good idea to see like when those expiring items are at and adequately planning for that so that your team is well aware to replace all those items when they come due. So yeah, and obviously CapEx projects directly works hand in hand with the construction project management team. So materials, labor, sourcing, outside contract relationships. It's all a matter of kind of just portraying the plan to that team and making sure that the scope of work is defined and the materials and everything is going to arrive on site on time within budget according to their schedule. So yeah, and then also with lender compliance as well. So the reserve and escrow balance that they're going to keep on the property. Some programs, loan programs, are going to have taxes and insurance. Others are going to have more stringent CapEx reserves items. So it also depends on when the loan is getting funded as well, and like the funding schedule with the lender. So I would just say it's a good idea to keep reserves, but it's also a matter of kind of just working out this thing with your lender and saying, hey, we do need to get funded for this period since we have some unit turns and CapEx items lined up. So are we able to do that so that we're I guess economically or in like a survival kind of state of mind so that we're able to cover our debt at the end of the day, right? So yeah. And then monitoring, so tours and inspections at your property. So again, lenders are also going to have their inspection compliance and like the company that they're going to use for that, or engineering study that they may have on that. So obviously with a new like acquisition loan, you're going to have an engineering study, but throughout periods of the life cycle of the deal, they're going to want to have some inspection periods done. So it's a good idea to just stay on top of that and make sure that you're PCA is like up to date and in good standing, I would say. Yeah, and then annual budgets and also business plans are things that you need to update on a yearly basis. So we'll get down to this down here, but it's basically weekly, monthly, quarterly, annually kind of timeline, I would say. So weekly, it's just reviewing leasing traffic, going through that LASL strategy that I mentioned earlier, reviewing the occupancy, the trend on your property, and then monthly calls with your property management team. So this addressing all the KPIs, going through your operating expense ratio, seeing where you can realize some cost savings, right? And ultimately with your tenant relationships as well, just making sure that delinquency and evictions are at the top of your mind, and making sure that you're adequately addressing move outs and move ins at your property. And then quarterly, so with asset management, it's again working hand in hand with different teams. So with distributions, you're going to want to communicate with your fund accountant team, making sure that our underwriting and making sure also with like the acquisitions team that our underwriting is in line with our actual returns on the property, and that we're giving out distributions according to the actual performance on the property. So distributions can be done just pretty much automatically, like through an investment management software. But it's a good idea to just make sure that you're meeting those return metrics for your passive investors. And then investor communication. So even following up with your investor relations team, it may be a good idea to host some like portfolio analytics or asset management webinars with your like network, your pool of investors. Invite them to it, talk through a lot of questions that they may have. And that's another thing. So portfolio analytics, pretty much all the data that is generated at your property, you can extract that into a business intelligence platform like Microsoft Power BI, right? So it's a good strategy to kind of offload all of those different data metrics and have a system in place where you can take all that data from the PM software, extract it. If you need to scrub it a little bit, go through that process, but ultimately implement that into the portfolio analytics that generates like graphics, visuals, data charts, and just good areas where people can just observe the performance on properties across your portfolio. So yeah, and site visits and comp shops, I already mentioned this. Good idea to do it quarterly. Obviously with more struggling properties, you're going to want to do it like monthly. I would say, just to make sure that like property management isn't having too many issues, and we're well on plan as far as maximizing our occupancy and driving our NOI at the end of the day. So yeah, site visits can be done quarterly. It also depends on how like broad your portfolio is and the different markets that you invest in. So it could be a challenge if you're investing in the West Side in California, and then you have some units in the East Coast, or you have in Midwest Central. So it also just depends on the organizational structure, and if your company is like institutional and you have like other asset managers within your team that can manage like a handful of properties in that region. So there isn't like too much back and forth within the different regions, and I guess you're not really getting like airplane sick, I would say, from all the flights and everything. So yeah, but essentially that's that. And then reforecasting cash. So basically adjusting your budgets for the year, or also just on the fly as well. Like let's say you budgeted for a certain amount for your insurance, but you realize that there's like a fire damage at the property. Now your premiums like through the roof, or other instances where you just have to adjust on the fly. It's a good idea to just reforecast cash throughout the year. And then quarterly, again, business plans, budgets. Business plans are things that you just really need to keep in the back of your mind, and make sure that the property is going according to investment strategy at the portfolio management level, and what they're like requiring as far as like sustainability goals, performance goals, overall like communication and like interpersonal like goals as well within like tenants and on-site staff. That's a good idea to just make sure that you're staying compliant with that. And then budgets is another thing, which should be kind of audited yearly, making sure that you have a attainable like operating expense ratio that you can meet at the end of the year. So that's just one thing to keep in mind. And then there's some other things I maybe just like scrolled over, but communications. So again, portfolio compliance with the portfolio management team, making sure that we have like established debt and equity providers. With an integrated company, you're gonna have your like mortgage brokerage company like in-house. You're gonna have your capital like company in-house that can make that process just like a lot easier. But it's a good idea to make sure that at the actual like debt provider, service provider level, like what program are we going through? Like, is it Fannie Freddie? Is it FHA and HUD? Making sure you're reviewing loan term sheets, making sure that you have all the right debt terminology in place, right? So that you can properly evaluate a deal, and also just communicate with the acquisitions team about how they underwrote it as well. So yeah, and then monthly reports are huge as well, because these monthly reports from an asset management level, you are auditing, you're making sure that line items are correctly categorized, and financials are pretty much like solid and in place, and you're relaying this back to the fund accounting level, which will help out in preparing tax returns for year end. So that's another thing to just keep in mind, that you're providing all these necessary docs, rent rolls, T12s, month to date financials, general ledgers, AP and AR, aging summaries, right? Everything that delinquency reports, like every single item of financial like capability that is in your software. You want to make sure that you're extracting, you're scrubbing, you're making sure that it's in place, and you're communicating that back to the fund accounting level, so that they're like, it just makes the process a lot smoother. Yeah. And then obviously chart of accounts as well, income statement, balance sheet, cash flow statement, all of that. So yeah, and then acquisitions and disposition support. So within new assets that come in the portfolio, it's really good to stay like in touch with the acquisitions team, just to see like how that takeover process is going to come about, right? So once the acquisitions team is under contract, they're going through their due diligence, right? And all the necessary like third party reports and everything is ordered, and they're kind of keeping like in touch with the lender and every other party involved, like to pretty much like transfer like all the nuances of a property to the buyer. So basically from the seller side, you're pretty much transferring all the different systems that you had in place to the new buyer, right? So old utility like programs, right? You have your like if you had security systems installed, then you need to transfer that. The PM software, like all the data and everything, you need to extract that and transfer it to them. All the necessary seller docs, service contracts with outside vendors. You need to restructure, renegotiate. So it's a matter of just transferring everything to the new buyer and making sure that takeover is done like successfully. So it helps to have asset management assist in that, because they have like property level like know-hows about all this. So definitely asset managers and acquisitions, they have to work hand in hand within a new acquisition of a property. So yeah, and then the long-term disposition and exit strategy for the asset. So now this is one thing that I'm going to get into. So this is an underwriting model from Lone Star Capital. So this is great. I found like tremendous value in this because it's one thing that I was not addressing in my initial underwriting. And I just like it just like blew over my head. Like I did not like even think about it. So the amount of insights that I got from that company, Lone Star Capital, is great, and I highly recommend just checking them out and maybe scheduling a call, like a passive investing call, and just getting to know like great sponsors like that, and the ones that have experience as far as like the acquisitions, the asset management, and actually like good performing like full life cycle deals is huge. So it's a business model that a lot of people can replicate, but it's a matter of establishing all the different connections that you have and structuring this team out to take on larger investments. But this is their sensitivity analysis, which I found tremendous value in. So essentially, you're doing an occupancy stress first. So break even occupancy and then minimum DSCR. So break even occupancy is basically what's the minimum occupancy that we can have so that we're at least able to cover our operating expenses and our debt service, right? So at the end of the day, we're realizing $0 in cash flow after debt service, and we're seeing what impact that has on our minimum DSCR as well. And just seeing the downside scenarios within like the refinance. So obviously with the refinance, your lender is going to check your DSCR, your debt yield, other loan covenants that are in your property or the loan program that you initially acquired your deal through. But essentially with the refinance exit test, this is a big item that addresses loan maturity risk. So essentially you're mapping out your refi period. So whatever refi period that you had in mind, and you can work hand in hand with like the sensitivities for your LP net IRR. So basically, if you track your LP net IRR over some of these stress tests and realize what the ideal or the highest maximum LP net IRR that you can obtain, let's say like within a hold period, right? You can adjust your refi period to that year. Obviously, you need to make sure that your actual acquisition loan is able to support that. So if it's like a 2 or 3 year term loan and you need to find a way to refi within 2 to 3 years, it's not going to really help if you have like a ideal LPRR at like year 6 or something, right? But basically, just finding out what the ideal time to refi is a big scenario. But basically, you're applying an operational shock. So here it says decline in effective gross revenue, that is, and seeing an impact on your NOI, right? So if you decrease it by 10%, what impact is that having to my NOI? And then ultimately down here to the exit test here, you're seeing from the operational shock what your actual NOI is as a result of that, the valuation on your property, according to obviously that exit cap rate in that period of time. But also the loan amount that you can obtain, the minimum LTV that you can obtain, or like maximum LTV, and then the minimum DSCR that you have to get. So basically 1.25 is the kind of industry standard for most loan programs. So keeping that a goal, making sure that you're above that or have like 15-20 basis points above that, that's definitely a good goal to keep, to track on a monthly and also yearly basis. So yeah, and then capital market shock is essentially decreasing your increasing your interest rate and also your refi cap rate. So within the refi period, let's say you had projected a 5-year hold period, you had a 50 basis point cap rate expansion. That means that each year your cap rate is expanding 10 basis points, right? So according to NOI, I don't want to get too off topic, but NOI is going to increase by 2% per year according to that. But essentially, you're seeing how much expansion are you getting at that refi period? So whether it's like 2 to 3 years in, maybe you want to adjust for like 30% cap rate expansion, right? Or let's say capital market environment right now is really volatile. So maybe you want to increase like 30, 40 basis points, right? So you're seeing also the impact that that has, again, on all the basic terms, NOI, valuation, loan amount, LTV, and DSCR, right? And the most rigorous test is just the both of those. So if your loan amount is sufficient to cover your existing balance in that time period, then you're good. Like you pretty much stress test the downside scenarios and you're able to refi without any problem. But if it's not, either one of these is like not like sufficient and the refi proceeds are well below the current outstanding balance, that's not a good scenario to be in. So this refi test is really great because it just allows you to just gain insights addressing, again, loan maturity risk within like the refi scenario. So, and then some other sensitivities that I saw were really good. With rent growth, it depends because some properties, for instance, mixed income properties are going to have different tenant bases. So like a LIHTC program, maybe like 60, 70% affordable housing, 30% is like conventional rate. So you have different like rent like growth periods that you can have. So within affordable housing, you have mark to market. So essentially your properties are getting reassessed like year after year or like every 2 years. And according to like the regulations and the LIHTC program, if it's available to increase those rents by a certain amount, right? So that's called mark to market. So really it's in the hands of the legislation. But those conventional units that you have the capability to increase rents, that can have an impact on your annual rent growth across the unit types, right? So yeah, and so for instance, here you're stress testing annual rent growth versus exit cap rate. You're also doing stabilized vacancy rate versus rent growth. So stabilized vacancy rate is obviously once you complete your lease up and it's reached its maximum occupancy, that's the vacancy rate that you want to look at. And then these are the hold period sensitivities. So basically you have your hold period versus your exit cap rate, hold period versus stabilization time. I think that's really these two items right here, exit cap rate and stabilization time, are probably the most like variable items that many multifamily operators have. So stabilization time is an item that you can vastly over predict or under predict, or it's tough to kind of gauge how long that stabilization period is going to be. Because let's say you have like a 6 to 12 month like construction plan. On top of that, maybe it's going to take like 6 months to lease up. So you're really in that like 18-month to like 24-month, or I would say year and a half to 2 year time frame to stabilize your property, right? So it takes a kind of keen eye to accurately address like the stabilization time. But if you can do that, you can see like what the maximum IRR according to that, and the ideal hold period as well according to that plan would be. So yeah, and the acquisitions team is basically going to do this stuff like sensitivity analysis. So it's a good idea to just ask questions about this, make sure that you're providing your insights from like the property level data, and also making sure that your experience obviously within construction project management, the hold time, supply chain issues, or areas where you can experience bottlenecks within your construction process. You're addressing some of these issues so that they can accurately adjust what the stabilization time may be. So yeah. And then other sensitivities you have here, average annual return, equity multiple, first year cash on cash and 5-year average cash on cash. So you can customize like all of this according to whatever return like criteria that you have for your investors. But it's a good idea to just keep some of these so that you can see like if like for instance like bad debt increases by a certain amount, or vacancy increases by a certain amount, or you're off on your exit cap rate assumptions by like 20-30 basis points, to see like what impact that has on your returns. So yeah, fantastic resource that I found tremendous value in. So highly recommend checking out this company, Lone Star Capital. So yeah, and kind of going back to I would say the approaches in asset management. So you have different types, right? You have the people that are, and I'll tell you like where I kind of stack up in this as well. So I'm gonna be completely brutally honest about like where I kind of fit into this realm of asset management. But basically, you have analytical asset managers, operational asset managers, transactional asset managers, and comprehensive asset managers. So 4 different types that I thought was like a cool way to kind of lay out the roles and responsibilities, right? And this is a source. It's from Institute of Real Estate Management, but it's really just going through all the different like roles and responsibilities and how each and every one of these types of asset managers addresses that, right? So, for instance, for analytical asset managers, acquisition support. You're pretty much staying on top of the capital market environment. You're reviewing loan terms. You're kind of justifying the acquisition's underwriting assumptions and making sure that it's well fit for the business plan, right? And then obviously with business plans, you're measuring the goals in the business plan, seeing like what can be achieved, what's feasible, all that stuff, right? And actually, let me just do this like side by side. So that would be like acquisitions, support, and business planning for analytical asset managers. Now you have operational asset managers. So now they're involved more in like the capital expenses, communications with the construction project management team, the actual like operating setup with like the property management team, and also doing a little bit of vetting with the underwriting assumptions as well. And then operational ones are also going to address the goals, the business plans, what's actually achievable, what's not. So they're actually going to get more critical about that, right? And then with transactional asset managers, you have people who are more on top of like the actual data. So rental rates, absorption rates. They're going to be on top of like comp surveys, rent comps, right? So all of that stuff to help give better insights in underwriting, right? And then for the business plan, they're going to be more involved in like the actual leasing process. So reviewing lease terms, setting up leases, communications with brokers, right? So all of that stuff, right? And then comprehensively, like it's people that can do like all 3 of those, right? All 3 that I just mentioned. So where I stand, I would say I'm more on the analytical side. I understand how to evaluate a property, go about a business plan, the necessary steps in that. But it's a matter of expanding my personal skills in operations and getting more involved in the day-to-day activities that are involved in maximizing performance. So whether it's from a capital expense perspective or the property management perspective, that's definitely something that I need to work on and improve. And then transactionally, I think I'm also I have like a mixture of that as well. So communications with brokers about like market data, secondary sources, also from the property level sources with other connections with property management teams, and getting insights as far as what they're offering at their properties. I definitely think I have some of those skills. So I would say a mixture between analytical and transactional is where I stand. And then team leadership. So analytically, people are analytical asset managers are going to be more involved in the on-site staff selection and monitoring their performance. Operational asset managers are collaborating, actually meeting with them, having like an actual genuine conversation with them, and just like strategizing with them. Like it's more like direct, like face-to-face conversations that operational managers have. And then from the transactional perspective, it's really just setting these goals and making sure that you can delegate some of those tasks and responsibilities to people who have like the analytical and operational skills, right? Yeah, and then budget prep. So next thing would be budget prep. So analytically, you're refining it, you're seeing the variances, you're also seeing the implications of the market conditions and the exit decisions as well, right? So you're keeping that in mind. Operational wise, you're evaluating your budget variances. You're really like with operations, you're identifying the problems before they happen. So that's a huge skill within asset management, is just identifying things that are about to happen, and you can just go in there, address it, and mitigate it right away, right? So that's a huge skill that many like analytical and transactional asset managers don't have, and it can really be a huge benefit. So yeah, and then transactionally wise, you're empowering others to make the budgeting decisions. You're maybe offering a few insights from your communications with your brokers in order to focus more on the lease up process at the properties, right? And then from the lease and capex like approval side, you're from the analytical side, you're evaluating the financial impact of the lease structures and the capital outlays, right? And then from the operational side, it's a reverse of that. You're seeing the impact of the lease structures and the capital planning actually on the on-site staff. So it's really a human like relationship that you have with the on-site staff, and making sure that they're well capable of actually taking on these like complex lease structures and other types of like voucher programs that they may need to do a little bit more research on and gain some insights on. So it's a different skill that operational asset managers have that is a huge value. And then transactionally wise, negotiating lease terms, capital improvements with the prospective tenants. Again, it's maybe spending some money with brokers on leasing commissions, or it's communicating directly with property managers to provide leasing insights, right? So even like transactional asset managers might also be like licensed real estate agents. So they definitely have like more like insights as far as like maximizing lease value. So yeah, and then operating efficiencies analytically, you're analyzing the data from not only primary sources at the property level, also from secondary sources. You're spotting trends from an operational perspective. You're refining your policies, right? Your SOPs, standard operating procedures, and making sure that your team is in compliance with the rules and regulations of the building, the relationships that they're keeping with tenants, and also if there is like affordable housing restrictions as well. You're staying on top of that. So yeah, and then transactionally, you're evaluating the impact on operating expenses on leasing, right? So yeah, and then the financial analysis from an analytical perspective, it's really a matter of having financial modeling background. So for instance, I've communicated with like adventures in CRE, financial modeling. I've taken like courses like through Coursera, Udemy, like for financial modeling. I've kind of understood how to develop a ground up development model as well as a acquisition model from scratch. And also implementing other like complex variations in that. So analyzing operating cash flows, doing a net present value and time value money calculation, doing a discounted cash flow analysis essentially, implementing complex waterfall structures for partnership level like returns, and also implementing like this like stress test and sensitivity tests, which I just reviewed. I don't want to like take credit because these are actual like other people's underwriting models, but I understand the actual equations that go into all of these different cells and all the different references that you need to make, so that you can actually create it like from scratch. And that's a goal of mine as well, in the future, is to create some of these models from scratch so that I can actually have a comfortable like model that I can rely on. But that's kind of like long-term goals. But yeah, and then the operational wise, you're providing the inputs for the financial models, right? So you're just abstracting data from communications and other relationships and other sources, and you're just providing inputs to the acquisitions team to support their analyses, right? So, and then transactional managers are going to use the models for deal evaluation and ultimately the leases that they structure. And then getting now to the market research side. So analytically, you're evaluating secondary data from reports and surveys. Operationally, you're evaluating primary data collected at the property level. I would also say analytically, you can just, there isn't really too much of a difference between these. It kind of just works hand in hand. You need to stay on top of the actual performance at your property, the competitive landscape within your market, and ultimately the secondary resources like Yardi, CoStar, RealPage, right? All of that, right? So yeah, and then transactional managers are going to just evaluate the primary, okay. And then last few things, so disposition assistance. So analytically, conducting financial analysis and sell holds decisions, like buy or hold decisions, right? So basically with the refi test and the exit test, you can see like when the ideal time to sell would be. Obviously you can track this with like actual performance and seeing if you met your IRR hurdle or your target IRR, your cash on cash and equity multiple, but also just seeing according to the portfolio strategy with insights from portfolio management, if that particular property in that particular submarket is a longer term hold, or if it's wise to dispose from the portfolio altogether, right? So that's like analytically. Operationally, you're mainly looking at the physical distress nature of the property, seeing if like maybe there's a bunch of deferred maintenance or you didn't really address all your capex items, or it's at risk of devaluing based on the property condition, right? So that's operationally. And then transactionally, reviewing like leasing trends, seeing if your property is generating enough like leads and leases, or let's say like the overall population or the migration in that market has just dramatically dropped, and that's going to have an impact on your ultimate occupancy. Those would be times to consider either selling or holding, right? And then lastly, surveillance and reporting. So analytically, you're benchmarking, you're doing like comp surveys essentially. You're conveying this information to owners. You're even just implementing some of this data into your portfolio analytics and presenting this back to investors and owners. Operationally, you're identifying like maintenance and tenant relation problems and addressing like the tenant satisfaction, retention rates at the properties, and ultimately making sure that your property is well maintained with adequate staff and good like vendor relations, right? And then transactionally, tracking like emerging like tenant demand trends or leasing trends or all of that. So these are kind of like the four main approaches. So analytical, operational, transactional, and comprehensive. The biggest skill is to have like all three of those. So being the comprehensive asset manager is the goal. But naturally, many people just fall into one or the other three of these buckets, right? So it's kind of a matter of just like adjusting your skills, observing your skills, like being critical about like your day-to-day activities and seeing where you can improve from all three of these perspectives, right? So yeah, that's a cool like little graph that I saw that definitely kind of intrigued my I guess my personality in asset management. So yeah, and then these are just some other slides that I found through there. So yeah, definitely some cool things to kind of keep an eye out for. So yeah, thank you again for watching. I hope you guys found value in this video. If you did, leave a like and subscribe, and maybe share this. This was definitely a longer video, so definitely packed with great insights and areas where you can implement some of these strategies into your day-to-day operations, right? So yeah, so thanks again for watching, and stay tuned for more. Peace.